Have you ever wondered how the stock market works? You hear about it all the time, stocks going up, markets crashing, people making millions or losing everything. But what does it all really mean? Hi everyone, welcome back to my YouTube channel. In this video, I'll break down the stock market, its history, key indices, and what's happening in the markets today. Stick around because by the end, you'll have a solid understanding of how it all connects. Let's get started. What is the stock market? The stock market is a centralized marketplace where investors buy and sell small parts of companies called shares. When you buy a share, you essentially own a small piece of the company and you can make money if its value increases. Additionally, some companies pay dividends, which are regular payments to shareholders, typically derived from the company's profits. Investors can also benefit from potential price appreciation, basically where the stock's value increases over time, allowing them to sell it at a higher price than they initially paid. It's a vital component of the global economy, enabling companies to raise capital, investors to own a portion of these companies. The stock market operates through stock exchanges. These are platforms that facilitate the trading of stocks and other securities. Some of the most major stock exchanges are Nasdaq and the New York Stock Exchange. The stock price fluctuates based on supply and demand dynamics. When more investors want to buy a stock, that is demand, than sell it, that is supply, the price rises. Conversely, if you want to sell more than buy, the price falls. Various factors influence these price movements, including company performance, economic indicators, investor sentiment, geopolitical conditions, etc. etc. As of end of 2023, the total market capitalization of all publicly traded companies worldwide reached approximately $124 trillion. dollars. The United States of America holds a significant portion of this market, accounting for about 63% of global equity market capitalization. Now, let's talk about a brief history of the stock market. The origins of the stock market trace back to the early 17th century. The Amsterdam Stock Exchange, established in 1602 by the Dutch East India Company, is often considered the world's first official stock exchange. The New York Stock Exchange was founded in 1792 under the Buttonwood Agreement in the United States. From its initial 24 brokers, the NYSE has grown to become the largest stock exchange worldwide. Throughout history, stock markets have experienced periods of significant growth and severe downturns. Some notable events include 1929, the Great Depression. During this time, the stock market crash of 1929 led to a massive loss of wealth and prolonged economic downturn. 1987, Black Monday. On October 1987, stock markets around the world crashed, with the Dow Jones Industrial Average, the DJIA, dropped by about 22.6% in a single day. 2008, the global financial crisis. Triggered by the collapse of major financial institutions, global markets experienced severe declines, leading to widespread economic hardships. And the latest one, 2020, COVID 19 pandemic. The onset of the pandemic caused rapid market declines, but unprecedented fiscal and monetary interventions led to a swift recovery. Now, I want to talk about some major stock market indices. Stock market indices are statistical measures that track the performance of a specific group of stocks, representing a particular market or a particular sector. They provide insights into market trends and serve as a benchmark for investors. Some key indices include the Dow Jones Industrial Average or the DJIA. This index comprises of the 30 major US companies and is one of the oldest and most widely recognized indices. The S&P 500. This index includes 500 of the largest US companies representing about 80% of the total US equity market capitalization. Nasdaq Composite. With over 3,000 stocks, this index is heavily weighted towards technological companies, reflecting the performance of the tech sector. Nifty 50 in India. the FTSE 100 in UK, and the Nikkei 225 in Japan. These indices represent the largest companies in their respective countries and provide insights in their respective domestic markets. Historically, the S&P 500 delivered an average annual return of around 10%, making it a very popular choice for long-term investors. Now, let's talk about the stock market today. Currently, the stock market is experiencing volatility and it's influenced by various factors. Number one, inflation concerns. Rising prices have led to fears of a decreased purchasing power, impacting consumer spending and corporate profits. Number two, interest rate hikes. To combat inflation, central banks have increased interest rates, affecting borrowing costs for individuals and businesses. And number three, geopolitical tensions. Global events such as conflicts and trade disputes have introduced uncertainty, leading to market fluctuations. Now let's talk about some key trends. Number one, the tech boom. Companies specializing in artificial intelligence, cloud computing, and other technologies have seen a significant stock price increase. Number two, retail investors. The rise of user friendly trading platforms has empowered more individuals to participate in the stock market, increasing market liquidity. Number three, the cryptocurrency integration. Digital assets like Bitcoin have gained traction, with traditional financial institutions exploring big blockchain technology. And number four, the economic growth projection. While some regions anticipate robust growth, others face challenges, leading to mixed global economic outlook. In conclusion, the stock market serves as a critical platform for capital formation and investment opportunities. We've explored its fundamental workings, historical evolution, key indices, and current trends shaping today's investment landscape. If you found this video informative, please make sure to like and subscribe for more insight into finance and economics. Share your thoughts on the current market condition in the comments below. Thank you for watching, and I'll see you the next time.